Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Pierre Debbas, managing partner at Romer Debbas, Shimon Shkury, he is founder and president of Ariel Property Advisors, and Bernadette Brennan, managing director at Serhant Commercial. We're here to discuss the impact of interest rate policy on housing, investor demand, and alternative forms of financing. It is great to have all of you with us. Welcome to Trade Talks. Pierre, we're going to focus on New York City here for the most part. Give us a high-level overview. It's such a fascinating market because it's not indicative of what you think of the housing market across the U.S.
You know, New York City, and Manhattan in particular, is a bubble. It's completely insulated from a lot of the trends that take place throughout the country. Now, what we've been seeing the last few weeks is a significant uptick in interest, in demand. It's starting to translate to deals. And the funny thing about this is that when the Fed cut rates, mortgage rates actually ticked up a little bit,
right,
which is the irony of it. But consumer confidence and interest increased significantly because there's a light at the end of the tunnel now. They view it as an opportunity where, okay, we know that this is going to take place, as opposed to just talking about it. And it's been really nice to see that, you know, people are coming off the sidelines. And I think if we continue down the trajectory of the additional rate cuts, which is supposed to be another 150 basis points, it will really lead to a strong year going into next year.
Shimon, is it a question in the New York City market of supply versus interest rates? It seems as if outside of New York City, it's supply that's really the issue relative to rates. Is that the same in the New York City market?
It's interesting that you asked that, because supply, specifically on the residential side, is always lacking. So what you see is actually rents growing in an unbelievable pace. In the past 5 years, we've seen 25% growth throughout the city. The other part of it is regulation. There's a lot of regulation when it comes to housing, specifically in rent-stabilized housing. And that creates, that double whammy creates a scenario where rents keep growing, but we don't have enough supply. And in terms of trying to encourage build-outs and new construction, that's something that we've been lacking over the past 4 or 5 years. Only now we have a housing policy that allows for some tax abatement when you build rentals. So in New York City, the biggest issue is supply of housing. In some cases outside of New York City, it's not necessarily the case, and it's the opposite, where you see that the fundamentals decline because there's too much of it. Here, we need more of it.
We're going to get back to regulation in just a moment here, but Bernadette, I want to get your insight on the commercial side. Of course, there's a number of over-leveraged office properties, and they're talking about foreclosure and so forth. Are we at the bottom, one? And two, how do you manage that when a building's coming to foreclosure?
Yeah. Well, one of our things that we've always stayed fast on is trying to stop that from happening for our owners. So jumping in as soon as that's happening, as soon as their payment's going to default, or as soon as something's happening along the lines of them with the bank, and trying to kind of bridge that gap there between the lender and that relationship and our seller and them trying to move the property. So a lot of our specialty and a lot of our business has been coming from just avoiding that foreclosure. So just trying to bridge that gap and do a deal in between before the foreclosure happens is really where like a lot of our deals have been getting done.
Right. So how do you do that if you can't make the payment? How do you stop?
You put it to market, and you bring it to market, and then you heavily start dealing with the bank to try to get them to stay off and hold off and to kind of suspend the process while you bring it to market and receive multiple offers, or try to bring it to a place where it's going to transact. So a lot of the issues is that what is due on the loan is less than what the market is going to pay for. So getting the seller to say, okay, we're going to trust you to do this, getting the bank to say, okay, we're going to lose a little bit of money here, and then getting a buyer in at that point where they feel like there is, some value for them, and that they're still able to get their deal, for whatever their purpose is.
Do residents have that luxury as well?
Not so much, no. I mean, I think the difference between this cycle and what we saw back in the financial crisis, banks don't want the assets now, right? It's been a half a decade of tumultuousness in the lending environment going back to COVID. And in the last few years, with the way interest rates have gone, banks keep giving extensions. It's all extend and pretend is the catchphrase that people use in the industry. And that's why you haven't seen a massive increase in foreclosures and defaults over the years, because banks are working with borrowers, especially in the office space. No one knows what a lot of these buildings are actually worth. So the lender will extend your mortgage, they'll work with you on a payment schedule, and they'll be more willing to take maybe a haircut through some principal forgiveness just to get out the majority of the indebtedness and to get paid back. So I think now that you're looking, we're talking year 5 since the pandemic. I feel like a lot of this started at the inception of the pandemic. I think now you're going to start seeing, these properties actually trade, because how long can you keep kicking it down the road for?
There's definitely a learning curve there for the bank, right? Because they don't want to take a loss, and they're going to have to. So like on one of our bigger properties in Midtown in the business district, they just kept appraising and appraising and appraising. And I'm like, I am your appraisal. I am telling you what the market's willing to pay. We have a dozen offers here. I'm your walking, breathing appraisal, you know? So getting them to trust that and then bring themselves to the climate of where the market is like often a learning curve. But like you said, they'll just keep giving extensions while they try to figure it out. And if they feel like they have a broker that knows the market and knows what they're doing, they're often willing to trust, because what is their alternative? Going through this, multiple year foreclosure process within our court system, which is super backed up. So it's not going to trade or move. It's not going to move quicker in a foreclosure than it is if you're going to just sell it to market. So.
No question, the mortgage maturities are the biggest item that's on investors' table and lenders' table. And I think that one of the things that we're seeing now that we haven't seen in the past few years is the ability of lenders, or the will of lenders, to actually sell notes before they become foreclosed on. So we do that. Or you see that lenders are talking to their borrowers and willing to go to market together with a deed in lieu of foreclosure. And these are the things that we'll see probably more so next year. I mean, we've had a situation where we've had an environment of a very low transaction volume in New York City. If you annualize it, it's about $20 billion. The highest levels were $65 billion. So very low amounts of transactions, because people who don't need to sell just don't sell. But we're going to change that. We're going to see that changes probably next year.
So that's interesting. There are alternative forms of financing that it's increasingly getting more popular within the space.
Yeah, so there's alternative forms of financing, mostly for acquisitions, right? So if you look at private money today, that is good mostly for value-add transactions. So for example, if we're funding, or if we're helping a client buy a multifamily asset that could be stabilized in 2 years and needs a tremendous amount of capital to go in and stabilize that asset, that's where we have private capital that goes in the form of a bridge, usually high single-digit to low double-digit interest rates, and then you can exit hopefully in a much better interest rate environment with CMBS, with agency, or with balance sheet lenders. So the forms of private capital that are here today to finance acquisitions are mostly for value-add transactions.
Yeah, interesting. Well, I mean, if there's demand for that product, I mean, they'll certainly package it and you'll find investors for that.
Yes.
What areas of New York City are developers looking towards for new development? I'm trying to wrap my head around this. Manhattan is an example. I mean, where are you going to build, right?
You're looking now really up. Yeah, you're looking to convert, or you're looking for those areas like West Chelsea is big for us right now, because most of the galleries are no longer, and they're aged out of their heyday. But what are you going to do with this vacant office? So a lot of our listings now in West Chelsea specifically, because they have that M1, M5 conversion, where you can turn it into a residence. Everybody's trying to figure out how to do the conversion project, how to get an office into that space. And we have to catch up legislatively on it. We also have to catch up with what's happening with the developers versus what's happening in the market right now. So it's like there's a difference right now between what the developers are looking to get into and what we're allowing them to do with all of our red tape, right? So I'm seeing a lot of interest right now in stuff like in West Chelsea, like in the vacant office stuff. And I think it's also kind of spreading out into Brooklyn and into other pockets where there's such a lack of inventory for housing that everyone, I mean, you see in Brooklyn, they're turning, a sugar factory into a residence. They're turning anything they can, banks, fire departments. It's such a lack of inventory. So just getting creative and finding those overlays where you can do like the M1, M5s or something like that and convert that into housing is really what all the developers are trying to sink into right now.
It's not easy to do either. I mean, converting offices to real estate, there's a number of architectural and coding hurdles there.
And zoning issues, right?
Well, Pierre, let's talk about that for a moment here. How impactful is city leadership when it comes to the real estate market in New York City?
It's massive in a good and bad way.
Right.
We saw, we were joking about, Bill de Blasio. One of the last things he did during his administration is drastically change the rent regulations involving housing in New York City, where it's become, very prohibitive for investors to actually invest and maintain quality housing in the city. It's a huge problem that we have. The regulations completely, were drastically changed in a manner where it doesn't make sense for a lot of landlords. I do think in a positive light, our political leaders in the city should really focus on changing some of our zoning codes to create this housing. I don't think that we have the apocalypse of office that the media likes to paint a lot of the time, and I don't think you're going to see as many of the Midtown, for instance, right, skyscrapers that are 50% occupancy convert into apartments. But why not take certain hotels and office buildings that are struggling and rezone those areas to create a housing, in particular affordable housing,
right.
which is something we have a huge shortage of supply on in New York City.
Well, it's a great point that you make. If coding makes it so prohibitive, it's going to be expensive to do those conversions. Where do you think that conversion cost is going to go? To the people who are renting or paying mortgages there. I mean, the cost is going to get passed down somewhere. They're just not going to absorb it. Let's talk about the migration we saw to the Sun Belt, right, in other cities outside of New York. The demand was there over the past 5 years. Do you think with the insurance costs going up in Florida, as an example, that it's going to impact those real estate markets and we might see people come back up from where they left?
The insurance costs are higher across the board. Yes, Florida is one of the areas that was affected the most. But the expense side of the equation grew even in New York City. So I think what brings investors back to New York City is alignment of incentives. And Pierre here just mentioned the HSTPA. I think you mentioned that, the Housing Stability and Tenant Protection Act. That's a state legislation that affected 1 million rent-stabilized units throughout the city, which means that you cannot increase rents as a landlord even if you have a vacancy. And what that did is three things. It allowed for vacancy to be there. There's about 20 to 35, 40,000 units that are rent stabilized that are vacant because landlords don't want to reoccupy them. It creates a situation where tenants live in worse conditions because these units are not renovated, and the city is not benefiting from better better housing in general. So we're trying to figure out, what we need to figure out is how to align these incentives. For example, why not give a landlord the ability to bring a vacant unit up to market if they put money into it? So these are the things we need to think about as a city in order to bring here landlords or investors.
Did you have 40,000 units?
About 40,000 units are vacant. Based on CHIP, which now is RSA, there's about 40,000 vacant units in rent-stabilized housing.
The owners just warehouse them, so they sit on them vacant, so that way they don't have to put another stabilized tenant in there, and then that doesn't go on generationally.
So there's hypothetically a solution here for
right in
units
front of
to be
us.
available.
Yeah.
What do you think is the holdup?
I think the regulation. I
political.
think getting
political.
getting our government, our legislator to see the other side of it, which is, a lot of people see this very wealthy landlord and they're like, oh, we don't feel bad for him, but a lot of them are smaller landlords, family office or multifamily, and they're really feeling it. They can't afford it. My one owner, again in the business district, he's sitting on a totally vacant building that's been fully demolished with the exception of 3 rent-regulated tenants that are in there. Now, there's an argument that it's not even safe for them to be in this type of housing. However, there's no place for anyone to go with that because they're in their tenant protection and he's unable to relocate them. So he's sitting covering an entire building, which is 28 apartments with 3 regulated tenants in it. So you can't even pay your taxes on that. You can't, there's no way to get ahead of that, which is why now we're in a short sale or pre-foreclosure.
I was going to say, so all you can do is sell.
Yeah, all you can do is sell.
So what happens to those tenants if the building gets sold? Will they still
stay? They stay there.
They
have
become
rights forever.
inherited with the. We're selling the building as is, which means the tenants come with the package, which is a big hiccup for most of the developers because then they can't do what they're planning on doing because they're now going to have to be in this either litigation or negotiation or spend
Oh, it's not even worth. It's not even worth. So the only alternative that they would have is to put the money in there themselves, to renovate the buildings, get it up to code or whatever, and still keep those 3 tenants.
Yeah.
So what's 3 out of 25? 3. That's 28. I mean, they lose that much money if they have 25 market rent payers versus and only 3 stabilized. Why wouldn't you take that risk?
It's about not even being able to build while they're in there, having those types of regulations, risking lawsuits for them in uninhabitable conditions because they're there while you're doing major demolition and stuff like that.
I think that scenario is even a better scenario than most in a way. I think that the other part of it is you don't have any income restrictions for these tenants, so everybody can live in a rent stabilized unit. And one of the solutions would be convert these rent stabilized units into affordable housing. So for example, if you have a big complex in one of the boroughs, maybe allow a landlord a tax shelter, property tax shelter, plus allow them to convert their tenants into subsidized tenants over time and increase rents. So there are solutions that the city can do in a systematic way if the city wants to do it.
So Pierre, the New York City Real Estate Expo taking place this week in the city, are these the types of topics that you expect to cover? Give us some insight.
Oh yeah, it's a full day of real estate information across the board.
So lawyers and real estate agents?
Everybody under the sun. We are expecting to have over 10,000 people come in and out throughout the day. It's been going on for probably close to a little over a dozen years, if I had to guess. And we've been heavily involved in it, Michael and I, since the beginning. Shimon's on one of our panels, Bernadette's on one of our panels. We do a whole day of continuing education credits on various topics, from housing, New York City residential, commercial, finance. Every aspect of real estate you can possibly imagine is covered. And it's covered by some of the leading experts in the industry. It's really great. You get hundreds of the top real estate professionals in New York City to all come together, provide content to the community. Everybody that attends is in some measure attached to the real estate world. And it's a tremendous event. It's probably the largest real estate event in New York City, I'd say, this year.
And I find it so fascinating because we don't typically cover real estate on the show, but this is a bigger conversation. We're talking about the economy, we're talking about affordable housing. I mean, these are, we have an election coming up. Those are two of the most important issues that hopefully we'll have some policy clarity on. But Bernadette, I have to ask you, we can't escape a conversation without how is emerging technologies like AI impacting the real estate space?
We've been really acclimating pretty well to it. We have Simple, which is our version of our AI beta that we've been testing at Serhant now for, I think it's a little over a year. We've been using it for everything from writing property descriptions to helping us to field what listings are available or coming available. We've been doing a lot of our pitches. I do a lot of my pitch decks on there. It's really been helping us to leverage what we're doing in a more time efficient way. Right. So it kind of gives us a great start, and then we kind of are able to build off of what it's doing. But it's great at just finding pictures, finding locations, getting us data. Before I do a property tour, I'll ask it, give me 10 things about the area, and it'll be like, oh, there's a Dwayne Reed on the corner, and there's this development, and there's this, and it gives you all your talking points, rather than you having to like hire someone or go through it or spend hours online. So for us, AI has really been great, and we've been emerging into it. And I'm not usually a tech person, so for me to fall into something like that wasn't necessarily natural, but it's like a bug. It's like once you have that itch and once you realize how to utilize it, you just kind of keep going back for more and more because it's a time saver. As long as you're managing it and speaking, reviewing what you're doing rather than just getting it and just rereading. It saves you probably like 80% of just starting from zero.
Shimon, it's interesting. We did a panel last week with Pierre's partner, Michael, and one of the panelists brought up that it helps you to identify clients, particularly on super high net worth properties, in a more effective way.
Yeah.
And I thought that was really interesting.
I think you're right. I mean, we have our own proprietary database that looks at every property and every owner that's in the city. And part of what we're doing with AI right now, which is we're testing it, is to figure out who would be the most likely buyers on the property when we get it. And our teams love it. And so that's one of the things that we're trying. And I think that, like you said, AI is one of these tools that will allow you to be more effective, more efficient, and you got to integrate it into your systems and into your companies.
Yeah. And Pierre, to wrap up here, it's interesting. They also made the point that this is no longer about wine cellars or gyms being available in the apartment buildings. The curation of, especially in that, the higher end buildings is just, off the charts. So that's why having these kinds of databases and leveraging those types of technologies have been helpful for brokers, within that category.
Absolutely, yeah, definitely. I mean, the industry, I'd love to fast forward 10 years from now and see the changes that are going to come about, because especially New York City, it's a global market. We have people from all over the world here. If you're able to utilize technology to be able to source, potential target and leads, globally, imagine how powerful a tool that would be for the brokerage community, in trying to, sell all these trophy properties that we have here. It's exciting to think about it in a lot of ways.
All right, appreciate. Oh, go ahead. Last
one. No, I'm just last thing. I want us all to remember how great New York City is, and so we have lots of challenges ahead of us. but the city is something else, something that everybody
Well, we're in the
wants
heart
to
of
be in.
Times Square, right?
Yes.
You can't get more New York City than where we are right now.
Yes.
All right, I appreciate everyone's insight. Thanks for
you.
joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.